Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Lori Graymont, and Lori's company is Summit Assets Group. She is the Vice President, Chief Operating Officer for that company, and has been working with real estate 23 years, since she was 3 years old. Lori started out helping mom and dad rehabbing properties. She's good with a drill and a hammer. She says her husband married her because of her power tools. Anyway, her company helps connect investors with opportunities for cash flow real estate properties. We have another program basically talking a little bit about the Birmingham and Atlanta markets that they're sort of concentrating in right now. So you might want to catch that show on our financialinsiderweekly.com website under past episodes. Today, Lori and I are going to be talking about real estate investing alternatives. So we're just going to sort of freewheel it here, talk about different ways that you can invest with real estate, and including buying a piece of property, but other alternatives. And it's just an introduction to a complex area. It requires a lot of study and due diligence. There are people that charge a lot of money for going to, 1 week programs. You can go to the Donald Trump University or whatever. So Lori and I are going to be doing our 28-minute version here. But I think you'll get some valuable information. Hopefully, we'll give you some inspiration and a place to start. And so away we go. So Lori, why should people even be thinking about real estate investment alternatives now?
Well, the main reason is they don't have the finances right now to get into real estate in the traditional manner. So let's just say traditional real estate would be buying a house with a mortgage, 20% down, and if you think the Bay Area typical house is going to be $600,000, a lot of people just don't have the cash to come in, or they don't have the wherewithal to qualify for a loan for that. So there's alternatives that still allow you to earn on real estate without necessarily owning it in a traditional manner.
Right. I guess another thing that we talked a little bit earlier, before this particular interview. But anyway, I mean, frankly, the alternatives, especially if you look at what you can get at a bank these days, frankly, they're not very exciting. You don't feel like you're going to even be able to keep up with inflation.
You aren't. Yeah, if you park your money in the bank and you think that you're safe and you're protecting your money, you're actually going backwards because inflation is eating away your buying power of that money sitting there.
Yeah. So, how about just, in mainstream in general? Well, I guess the other thing is people have been nervous because of the stock market. I mean, actually, it's been doing pretty well the last couple of years, so we don't want to say, no, you should not be in the stock market. But, by being in alternatives in addition to the stock market, it's a way of diversifying yourself further and having a less overall risk related to your investment profile.
Well, there is. And the thing about real estate is the movements in real estate are much slower than the movements in the stock market. And so when they say diversify, I don't think necessarily the best diversification is diversify everything in the stock market, because one thing can happen and the whole market can crash. So we just believe that you should be in different types of investments, such as the stock market and in real estate, however you can get in.
Mm-hmm. Yeah. Okay. And of course, the other thing is we are seeing some recovery in the market right now, but it seems like there's still a lot of opportunities out there from places trying to recover.
So there is huge opportunity in almost every marketplace right now. The key is being able to find the properties, because the hedge funds are in, the foreign investors are in, the U.S. investors are in, the main buyers, and so the inventory is pretty much at the lowest point it's been for 7 years. And so finding the deals is a little bit harder than it has been in recent past. But once you can find the deal, there's an opportunity there for you.
Okay. So let's talk about some of the different alternatives and what are some of the advantages and the disadvantages. Mm-hmm. And so one is just rental properties. And so what are some of the good things and some of the not so great things about being involved in rental properties?
Well, there's tenants, toilets, and headaches.
Okay.
You know, we call it tenants, toilets, and termites, but you know, the reality is when you own the property and you are the landlord, you're responsible for keeping the property in good repair. And we know all things have a tendency to break along the way, so there's going to be costs, there's going to be issues with tenants maybe losing jobs, not paying their rent. And so it's key to have a good property manager that takes care of those headaches for you so that you can get the cash flow on it. And to really look at the cash flow. The cash flow is what allows you to hold the property for future appreciation. If you're buying just on speculation, which is what everybody did in 2003 to 2006, we already know how that story ends. It might win for some, but in the end, it's not good. You need to have the cash flow in order to maintain and hold on to that property.
Yeah. So let's focus on that. Hold on to that property for a moment. Yeah. So, I mean, you've got to have some sort of reserves.
Yes.
It might help to have more than one property so that if a tenant in one property stops paying, where's the money going to come from to pay the mortgage or pay the property taxes?
Exactly.
So,
yes, for sure. For sure. Now, so there's the good part is that you're owning an asset that goes up faster than inflation. So, and you typically get cash flow more than what your costs are. So you get that along the way. The bad parts are that you have to manage it. Managing takes time. Whether you're managing a manager or you're managing the tenant yourself, you still have to manage it and you have to pay attention to it. So it's not like a 401k where you take it and you put it in and you look at the statement once a month and you throw it in the drawer. You might actually have to call your manager and say, hey, what happened? How come my tenant didn't pay this month, you know, or what's happening there? So it does take some active involvement.
Okay. So what about there's been a popular movement, maybe I think you were talking around with the speculating, but you know, did you see these things on television? You know, flip this house,
yes.
And you know the quick turnaround type of thing. So what do you think about that type of?
Okay, so there's a couple different cuts to flip this house. So the first one is called wholesaling, and wholesaling has the least amount of risk involved for any investor. But let's understand that this really isn't investing because you're not holding it for any period of time. It's a job. You know, you're trading your hours and your opportunity for money. And so it really is like an ordinary business. So you simply find a house, you tie it up in contract, and you assign that contract to somebody else who's going to buy the house for a little bit more than what you have it tied up for, and you make money in between. It's called wholesaling. Now, Flip This House is all about buying the house, fixing it up, and then flipping it out. And I always encourage people who are new to rehabbing to not do this. You know, when I first got started in rehabbing, I was probably 10, and I lived with my mom, and I got to move into the house and tear out the carpet and hang the sheetrock and live there until it was done, and 2 years later, after it was done, we'd move and we'd start over. Then I had to do it on my own with my own money, and I was scared to death. And I called my mom up and I said, okay, what advice can you give me on this house? Because I'm just about ready to close and I have my bid for it and I'm going to, you know, make this money. And she said, well, make sure you get 3 bids. And I said, okay. Then she said, you add them together. And I said, okay. She goes, okay, what? She goes, you add them together. That's how much your rehab's going to be. Those 3 bids added together. You know, we assume she's going to say take the average of the 3, right?
Right.
No, she was telling me that in a rehab project, you can almost always expect your bids to be more than what you expected, twice to triple. And when you're starting out, at a minimum, twice what you expect. Because a lot of times you go in and you think, oh, it's only going to be $10,000, and then you open up a wall and you have to put in a new furnace because the ductwork isn't there or something like that, and it ends up being a lot more. So it's a very risky business for a new investor to be in. Get a coach, get a mentor, get somebody to walk with you on your first deal so that you start to learn the ropes.
Right. I think the thing that comes out of this, though, is first of all, related to wholesaling and this, is these are businesses.
Oh, yes.
So it's not like a nice passive investor, I'm a landlord and I'm going to be clipping coupons. This is, you are involved going to be heavily involved in supervising this, watching what you better be,
Yes.
Or you're going to lose your tail, and you might anyway.
Yes, and
So-
you have to be willing to fire people. I've fired more contractors than most people will ever hire in their entire life, because contractors will say whatever they need to say to get the job, and then they give it to you in the bill. So you just
Or
really,
they might disappear.
or they don't ever show up.
Yeah.
Exactly. And then you sit there and you wait and you wait and you wait and nothing's happening and your clock is ticking. And if you borrowed the money to buy the house, that also costs you.
Yeah.
So yes.
Sweat time.
Exactly.
Okay. Well, how about so be warned, folks. But I mean, because frankly, I mean, people sell this as the way
Yes.
for you to get into income, and it can be, but there's going to be some a real learning experience involved, and so be prepared for that. You need to have a strong stomach. If you can't handle investing in the stock market, you probably won't like this one either.
No.
Okay, real estate partnerships. So let's talk about this as an alternative.
Okay, so there's not a lot of talk about TICs anymore, tenants in common. There was a lot of regulations on it, but when you partner with people, you can partner without a lot of formality. Mm-hmm. It can be as simple as a handshake, but I would never recommend it. Mm-hmm. If you're going to partner with somebody, let's say somebody has the money and you have the time, and you're going to go find a property and you're going to fix it and you're going to flip it, you need to outline exactly who's doing what and for what % of the profit. Don't assume it's 50-50, because maybe you're doing the bulk of the work and somebody's just bringing in the money. That might only be worth 25%. But outline it, put it in writing, have both people sign it so that there's no misunderstandings. We always talk about, one of the terminology is, figure out the divorce while you're in the honeymoon.
Okay. Oh.
Because it's a lot easier when you're both excited about a property and you're dreaming about how much money you're going to make on this property, to figure out how everything's going to be split, than when you're in the middle of the rehab and you have your 4th or 5th cost overrun and you realize your profit's almost down to break even to figure that out.
Yeah. Now, there are some that are actually put together really as an investment.
So yeah, those are TICs. So now that's or syndications.
Yeah, maybe a syndication
Yep.
or whatever. Yeah.
So what that is where you're basically investing your money in somebody who's going to do all the work.
Yeah.
And that certainly is a way to reduce your risk and your time commitment, but you need to vet who you're doing the investment with. You need to understand what recourse you have should that investment go south. Are you investing in a property with many people or just one other person? Is the money even being tied to the property or secured on the property? So syndication is definitely something that's good for people who want to reduce the risk, but you have to understand the whole picture of what the syndication is about. And that's a little bit of what this whole Bernie Madoff thing was. People invested in, and so you just really have to pay attention to that.
Yeah, but it can be a good alternative for some people.
Absolutely.
Because, again, what it means though is you're going to get less money on this deal, and that can be okay. It's because you're basically paying somebody else to take the headaches, and you're getting a cut of the whole thing, and. So they're paying you more for your money than they're paying you for you, and that can be okay. And it's just it's another alternative. But do your due diligence for anything that you do.
Just an example on that, Michael, is there's a lot of people who syndicate to buy an apartment building.
Yes.
And so they'll buy an apartment building that's dilapidated and vacant. They're going to fix it up, they're going to put tenants in it, they're going to hold it for a couple years, and then sell it to another investor.
Yes.
And that's a good syndication. As long as the money is going against the property and it's being secured like a mortgage or security deed against the property, and it's not just going into an LLC that could be going into the guy's pocket and nothing ever happens to the property. Mm-hmm. So you just have to pay attention to that. But that's a good way to participate in a deal bigger than you could do on your own with less risk because there's many people in it.
Yeah, and it helps to have people, again, they've got a track record, they've done this several times, and so you can have some confidence that they know what they're doing and hopefully that they're pretty honest.
Yes.
Okay, let's talk a little bit about private lending then. I think that's another interesting area that a lot of people don't think about when they're thinking of investing in real estate.
So we have a lot of private lenders that help us in our business. We call it earning on real estate without owning real estate. So there's people who don't want to deal with the tenants, toilets, and termites, but they want their money secured on the real estate. It's what mortgages do, banks do. It's the safest position to be in. And so let's say you had $30,000, $40,000 in an IRA. That might not do a lot for real estate here in the Bay Area, but you could loan that money to somebody who's buying a property in the Midwest or in Atlanta or Birmingham where we are and get 8%, 9% paid to you on that. You're secured just like a lender would be secured. So if they default, you've got maybe a 50% loan to value, so you're in the best position, but you're making cash flow on it almost to what they might be making if they had an 8% return on their money.
Right.
So,
and on some of these, you can actually have equity participation.
Absolutely, and that's one of the fun things that I like to do. When I loan money out, I might loan up to 50% loan to value, but then I also want to participate maybe 20% of the improvement. So if somebody is doing rehab and they have experience and I know who they are and I can see their track record, I might loan them some money and then I'll participate in their profit so that I also get some of that value that they added.
Right. So the nice thing about this, folks, is, again, related to, we were talking about IRAs and so forth, that some of these things that you try to do, if you try to do it in an IRA, you're going to have ordinary income. It's going to be subject to what we call unrelated business taxable income tax. And that can be pretty high now because you can get up to 39%, 40% pretty quick these days. So this type of an investment that we're talking about, you can have an equity participation. In a sense, you're participating in a business, at least the appreciation. You get this fixed return, get the equity participation, and there's no tax to the IRA or to the Roth. So this is actually one of the best ways, I think, to make investments through a Roth or an IRA.
There's not a lot of surprises like all of a sudden a furnace goes out or anything because it's just set.
Yeah.
You know, no surprises,
and
low
again,
risk.
you're not getting involved in a lot of the management problems.
That's right.
That you otherwise would have. What about note brokering? Maybe you can talk a little bit about that.
Okay, so in order to actually broker a note, you have to be a licensed broker in the state of California. But you can still participate. Let's say that somebody sells a house and they owned it free and clear. They sell the house and they take a carryback on that house, maybe for $100,000. And they're receiving monthly payments, but you know what? Now they want to go buy another house and they don't want to wait for all that money to come in over 30 years. That $100,000 note, they can go sell it to somebody for cash today. They aren't going to get $100,000, but they might get $60,000. So you could negotiate a price, the $60,000, and then you take it and you find somebody who will actually pay you $80,000 for it, and you make money on the spread. But you, again, need to do this under the regulations of note brokering, but it's certainly possible to participate in that. And it's a great way if you like the mortgages and understanding all of that.
Right. But then also focus on the thing that we talked about, this discount. So you may want to buy that mortgage for 60%, and now instead of getting 8% related to a mortgage, you're getting 15 or 20%.
That's right, because you bought it for the lower percent.
Yeah.
You know, and a $100,000 mortgage at 8% doesn't pay back $100,000. Right? A $100,000 mortgage at 8% is going to pay back closer to $180,000 because of that 8% over the 30 years amortization. And now you just got those payments for $60,000.
Yeah.
That gets exciting.
Right. Okay. So we've talked a little bit about investing in other areas. Again, in another program, you may want to take a look for that. Why don't we talk a little bit about due diligence? So I think this is a big, and this is the area that nobody really wants to deal with or think about, you know, but it's so necessary. Why don't you?
How about your book? It's in there.
Okay, so I should have brought my book today. So I have a book on investing using your Roth and IRA account. I do have a chapter in there on due diligence. And by the way, Lori contributed for that book. So,
Yes.
but let's talk about due diligence for a few minutes because it's so important when we're talking about real estate investments.
First and foremost, you have to know who you're in business with. Whether you're buying a house from somebody, through somebody, from somebody, it's important to understand because contracts only write out our understanding, but the person behind the contract will cause it to perform or not perform. So I just put that out there because I hear a lot of these stories where people were in contract to buy a house from somebody and then they went and sold the house to somebody else before everything was signed, so they really weren't in contract. They thought they were, nothing was signed. So you have to know who you're working with. Secondly, you want to know about the property. If you can't physically inspect the property yourself, get a property inspector that you can trust that is very thorough that goes out and inspects the property for you. There should be pictures included. It should hit every line item of that house from the roof ridge to the chimney down to, how is it grounded for electrical. So you should see all of that about the property.
Now related to that, folks, we're not just talking about a property that you are buying. We are talking about the property that is the security for your note.
Exactly.
So this applies across the board.
For any of these type of So, and then you want to look at the contracts that you're using. Make sure that you understand it. If it's not in a common language and there's a lot of legalese, pay the money it takes to ask an attorney to review it because that might be smart. I mean, it might save you money or thousands of dollars later down the road. So look at the contracts and what you're doing there. Make sure you understand the area that you're investing in, whether it's your security or whether you're going to own the property. Is the area safe? Are the schools good? Or do you need to bring the police in with you to go visit the property? We had a property once that was in Kansas City, and the police needed police escort.
That's scary.
Okay, guess what? I'm not collecting rent in that area, and I didn't feel very good about that security. So you need to understand these things, and don't take everything that you get from the person who's selling you as the truth. Verify it. Verify but trust. Trust but verify.
Maybe you need to hire an accountant to go and check out some of the figures.
You think so? There's definitely need to look at the numbers. The saying is, if it's too good to be true, it is. It is. Spreadsheet lies. People can make things look as good as you want on a spreadsheet or with statistics, all that kind of stuff.
Yeah.
But what is the truth? What's really there? What's under the numbers? Absolutely.
Maybe you could talk a little about, particularly about liens when we're talking, and we have a little different situation with liens in California than in other states. So
yes.
Maybe you can talk a little bit about that.
So each municipality has got a certain way that they handle their garbage, that they handle their property taxes, sometimes their sewer and water bills. And so you have to understand where the investment is. So let's say that you're in the Atlanta market. There, if you don't pay your water and sewer bill, they can file a lien against the property. And whoever buys that property is responsible for paying that lien. Not who's selling it, but who's buying it. In Birmingham, same thing with the sewer and water. Atlanta also has trash. If you don't pay your trash, that becomes a lien against the property. So you just really have to understand and talk to the attorneys. A lot of these states close with attorneys and ask them to research all the liens against the property before you get involved so that you understand what the real cost of that property is.
Right. And you may need to call some of these agencies because maybe if you call and just ask at the recorder's office, you may not find out about those liens.
Well, and so here's a thing. In Jacksonville, Florida, we have some properties there. The liens that didn't show up were the compliance liens. So if they had to go out and mow the lawn while the bank owned the property, you're not going to see that in a closing when you close on it, but you are going to get a bill once the compliance office gets your new name and address, and you have to pay for all the mowings that they did on the property. So it's important to call these municipalities, go from department to department, ask if there's any hidden liens, find out about the property so that you know. And this is whether you're going in as a lender, or whether you're going in as a buyer, whether you're going in as syndication, you do need to do your due diligence on all the parts of the deal.
This should make you think a lot, folks, about this is, this isn't a minor thing that we're talking about. I mean, this can be very rewarding, but there can be a lot of effort that's involved along the way.
Well, money is made in problem solving, and these are all problems, so that's why there's money made here.
So Lori, to conclude, do you think this is a good business to do as a Lone Ranger?
Oh, my favorite question. So, yeah. No, not at all. You do not want to be in this business as a Lone Ranger. You need to have yourself surrounded with professionals such as yourself, a lawyer, property manager, other investors who have been through this. One of the things that we often talk about Summit is our team has got 65 years of experience with all of the team members. And what that brings to the table is hard-earned wisdom. That means we've been in the trenches. We've learned through the school of hard knocks. And you need to surround yourself with people similar to that, whether it's going to a local RIA club or hanging out with other investors. Make sure that you've got your professional team set up and you've got your support team set up.
Great. Lori, I want to thank you so much for joining me today and sharing your wisdom and experience related to this.
Thank you.
I think that you've given our viewers a lot to think about because, there's all this excitement and thought,
Yes.
real estate, but a lot of people don't realize that they may be getting from one area that may be very high risk into one area that they don't really understand at all and that really has a lot of risk too. And
That's
so,
right.
The opportunities are exciting, but you do need to go in with your eyes open.
Your eyes wide open for sure.
Okay, well, I hope I'll get to see you again, and
Thank
it's a
you.
pleasure having you. Folks, we'll see you next time on Financial Insider Weekly.